market is designed fundamentally to test your nerves. It is a mechanism for the transfer of wealth from the impatient to the patient. The big money, the kind that truly changes a man's life, that establishes his family's future, is not found in the initial execution of the order. It is found in the agonizing wait, the volatile wait, the necessary wait. It is the wait for the major move to finally complete itself entirely. Your haste is your greatest expense. Your impatience is the market's primary profit. You must stop moving. You must learn to wait. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. The moment you execute the order, the wire confirms the price. You have entered your position. You followed the facts. You consulted the charts. You saw the pivotal point confirmed. You concluded correctly that the stock was set to run. You are correct. Yet, what happens next? Almost invariably, the market's very first move is not the soaring confirmation you anticipate. It is not the immediate, gratifying rise. It is a calculated, brutal test. It is a dip, a minor setback, a small, painful reversal. It exploits the inherent psychological fragility that every single man carries the moment he commits his capital. You see the price fall slightly into the red figures. You feel the doubt immediately creep into your judgment. You feel the cold dread of potential loss. You wonder if you completely misread the tape. You want to exit. You want to stop the pain before it deepens. Stillness, in this absolutely crucial initial phase, means gripping the conviction you entered with. It means holding that thesis with cold, clinical force. Stillness means resisting that raw, animal urge to cut the loss merely because the paper is temporarily stained red. If your analysis was sound, if the technical setup was honest, you must allow the trade the necessary room to breathe. You must hold for at least the initial defined period you set out. You defined your stop. You defined your rationale. Stick to it. That initial test, that small calculated drop, it separates the sheep from the lions, and the sheep panic. They cut the trade for a minimal loss, only to watch it turn around and soar without them. The lion waits. He is anchored by his evidence. You cannot make money unless you trust your own judgment enough to withstand the first minor storm. I have observed the habits of amateurs for 50 years. Their behavior is frighteningly consistent. It is a blueprint for failure. They cut their roses and they water their weeds. They allow their failing, losing positions to linger indefinitely, hoping against all reason that the market will reverse and rescue them. But the precise moment a trade shows a modest, comfortable gain, a few profitable points, they snatch it. They leap out of the market entirely. Why this haste? It is because the paper gain feels illusory. It feels tenuous. It is driven by the crushing, primal, internal fear that the market will return and take back the small profit they have finally secured. They are desperate to validate their action. They crave that small psychological win. True stillness utterly forbids this conduct. Stillness demands you let the profit run. It demands you let the market pay you. Not your momentary relief. Not your need for immediate comfort. I tell you this without exaggeration. I have paid for my biggest profits many times over with massive temporary swings back against my position. The market must swing. It must fluctuate. If you cannot endure the sight of your massive paper profit being cut by a third, perhaps even by half, in the course of a necessary correction, then you are fundamentally unprepared for the magnitude of the move you are attempting to capture. The size of the fortune you are trying to earn is directly proportional to the size of the volatility you must stomach. If you jump out for the quick comfort, you leave the major fortune behind. The hard-won lessons of timing and stillness in volatility, which often exact a crippling market penalty from the impatient speculator, were painstakingly chronicled by Edwin Lefebvre in 1923's Reminiscences of a Stock Operator, capturing the exacting psychological and practical methods of Jesse Livermore, referred to therein as Larry Livingston. Reading this essential text offers a unique, zero-cost training ground, a confidential look into the operator's mind that allows one to live the critical moments of decision without risking a single dollar of capital. For the modern trader, it is crucial to access the enduring principles through the Max Davidson edition, which provides the necessary contemporary commentary to translate the raw truths of the 1920s straight into today's complex trading landscape. A link to this essential edition is provided in the description below. You must stop thinking of high volatility as simple speed. It is far more cunning. It is far more targeted than that. High volatility is the market's calculated, sophisticated psychological warfare. It is designed specifically, ruthlessly, to shake out the weak-handed speculator. These movements, these severe, violent countermoves, the notorious whipsaws, they happen precisely when the underlying structural trend is strongest. The stock rockets up, then it crashes back down with frightening speed. You see the fury. You feel it twisting in your stomach. It convinces you, against your better judgment, that the original powerful move is definitively finished. The market is reversing. You must exit now. The average man capitulates right at this point. Stillness is the recognition that this specific chaos, this fury of movement, is nothing more than temporary noise. It is market chatter. It is the process of necessary consolidation. It is the testing of the new, higher levels. It is not the signal. Stillness means maintaining your structural conviction during the peak of this chaotic motion. You must look past the immediate price flicker. You must look through the noise to the overarching, undisturbed chart structure. You hold the line. You keep the position. No market move travels in a perfectly straight line. Never. This is a naive fantasy. The strongest, most aggressive market thrust requires necessary periodic corrective pullbacks. This is an absolute law of speculative movement. These corrections are not pleasant, they are severe. They are deliberately designed to be painful. They can easily erase 10%. They can easily erase 20% of the paper profit you have accumulated over weeks. I learned this truth through staggering personal cost. If you are unable to endure the sharp, searing pain of seeing your massive profit temporarily diminished during that necessary correction, then you are psychologically unprepared for the size of the move you are attempting to capture. The great money you are aiming for is fundamentally payment for enduring that drawdown. The market does not give fortunes away freely. It demands that you earn them through psychological discomfort, through fear. The speculators who panic when the market pulls back are simply paying the strong-handed speculators to take their shares at a temporary discount. They are gifting away their conviction. Stillness is the sheer brutal ability to sit on your hands while the countercurrent rages and attempts to drown your confidence. You must not move. You want the 20-point profit. You want the 50-point profit. You do not seek the 2-point scalp. Understand the crucial difference between these objectives. Small, negligible profits are captured by quick action, by clever timing, and by frantic, ceaseless trading. They are the province of the clock. Life-changing fortunes are only found through enduring, relentless, patient stillness. They are the domain of the professional. My rule, the one I forged through years of struggle and eventual triumph, is simple. It is the great swing that captures the imagination, and far more importantly, the capital. If you move too soon, if you greedily take that immediate small gain, you have captured only a pitiful fraction of the potential movement. You then face the immediate, disastrous risk of re-entry. You must now chase the price higher, buying into strength that you should have already been holding. This forces emotional, unplanned trading. It creates anxiety. Stillness keeps you anchored. Stillness ensures you capture the heart of the movement, not just the edges. The speculative game is simple arithmetic, provided you manage to remove the human element of fear and greed. The greater the patience you possess, the greater the potential yield you can command. Now let us be perfectly clear about what stillness is and what it is not. Stillness is not the passive act of simple hoping. It is not closing your eyes and wishing the stock higher while you ignore the facts. My waiting was always defined by active observation. It was vigilance without intervention. Stillness is defined entirely by constraints, by clear, rigid limits. You must have a clear exit point established and etched into your mind before you ever enter the position. This exit point is your final stop loss. Or, just as crucially, it is the clear, definitive technical signal that the major trend has decisively broken. If the tape continues to confirm the great swing is intact, despite the surrounding noise and volatility, then you wait. You remain motionless. But if the tape breaks the major technical line, if the established pivot cracks and fails to hold, then stillness ends instantly. Action is required, swiftly, decisively. Stillness is the disciplined maintenance of the position until the evidence demands otherwise. Not until your nerves demand otherwise. Your emotions are useless in this enterprise. Only the facts matter. Your capacity to remain perfectly still during the inevitable fury of volatility is directly mathematically correlated to one factor: your position sizing. This is a critical point that the vast majority of men ignore. If the minor daily fluctuations of the price cause you physical distress, if they interfere with your sleep, if they make your hands sweat uncontrollably, if they steal your appetite, then your stake is definitively too large. The sheer size of your commitment is undermining your psychology. It is preventing stillness from taking root. I learned through devastating losses to scale down my commitments to a manageable size. A size where the daily, weekly noise cannot shake my deeply held conviction in the major overarching trend I have identified. Stillness is not merely a difficult mental exercise. Stillness is an artifact. It is the necessary byproduct of proper, disciplined risk management. If you manage your risk correctly, stillness comes naturally. If you gamble, if you over-leverage, stillness is structurally impossible. You cannot buy quiet nerves. You must manage your capital in a way that allows them to exist. The amateur focuses exclusively on the tick. The professional, the true speculator, focuses on the calendar. I often waited weeks. Sometimes I waited months. I waited for the market to fully, completely mature my position. Movements, particularly those involving major economic themes, the great bull or bear drives that span years, these events do not unfold in 48 hours. They require substantial time. They must consolidate. They must confirm. They must correct. And then they must run again and again and again. The man who is fixated only on the hourly ticks, who is glued to the board, watching every minute flicker of price, that man is doomed to fail. He lacks the essential stillness required to allow the fundamental trend sufficient time to ripen and bear fruit. You're attempting to harvest a mature crop, yet you're trying to pull it out of the ground after 3 days of planting. You must respect the clock. You must respect the massive cycle of the market. Let the trade age. If you believe in the fundamental driver, if you believe the stock is going to 50, then why do you care if it moves by a single point today? The final movement requires months of sustained pressure. Give it the time it demands. That is stillness enforced by the calendar. Once the trade is fully confirmed, once it has broken the pivotal line and is definitively running in your favor, the process should become utterly, wonderfully boring. Stillness requires you to physically step back. You must let the market do the heavy lifting of price movement. The impulse to constantly monitor the trade, to intervene, to adjust the stop, to take a fraction of the profit off, that impulse is nothing more than a profound lack of faith in your own original analysis. You are micromanaging success. You are inserting doubt where certainty should reside. A great position, a true winner, should demand little or no day-to-day management. You check the tape only for confirmation of the overall trend structure. You confirm the major pivot points are still intact. You do not worry about the minor dips. Then you return to your life. The money, the fortune is being made while you are elsewhere. If you find yourself anxious, constantly checking the board, you are fundamentally wrong about something. If you are deeply, profoundly bored with your winner, you are likely correct. The market rewards the speculator who can forget he even has a position running for weeks on end. When, then, does the waiting finally end? I only ended my stillness and took my profits when the market reached a clearly defined pivot point, a point of exhaustion, a point where the entire character of the trend visibly changed. Stillness is the disciplined maintenance of the course. It is holding the line until the last possible moment of safety. But you must be ready to strike when the market provides the undeniable evidence that the fundamental momentum, the underlying driver that propelled the entire movement, has definitively, structurally, shifted against your position. You exit when the market tells you to exit, not when you feel rich enough. The market always knows when the movement is done. Your intuition is irrelevant. Wait for the signal. Wait for the structure to break. That final moment of stillness, the moment you watch the price hesitate, fail to make a new high, fail to hold a defined technical support, and finally break the uptrend line, that is the absolute signal. Execute the exit and depart. The successful speculator takes the lion's share of the move. He does not try, foolishly, to capture the last tick. The last tick belongs to the next speculator. You exit cleanly, decisively, and then you return to stillness. You wait for the next setup. My entire legacy proves this single, undeniable fact. The most powerful, devastating weapon a speculator possesses is not speed of entry. It is not cleverness of interpretation. It is absolute, total, ironclad control over his internal urgency, over his nerves, over his own human weakness of fear and haste. The truly successful trader does not cower before volatility. He does not fear the whipsaw. He sees that chaos as the necessary furnace. It is the fire that actively forges the conviction of the few strong-handed men who will survive. If you genuinely desire to capture the major move, the generational wealth, you must learn to be financially surgical and psychologically invisible. Master the wait, master the stillness, and you will master the market. You can watch hundreds of hours of content and read dozens of books about the market. You are filling yourself with knowledge, which is excellent. But knowledge alone won't make everyone rich. Because not everyone possesses the right foundation. The market is the same for everyone. The only difference lies in the mindset. You can have a perfect trading system, but if you lack discipline and an understanding of your own psychology, that system is worth nothing. I often see a recurring theme in your comments. It is easy to talk about strategy and theory, but when it comes to the actual trade, many struggle with emotions. For those who want to focus on discipline, patience, and self-discovery within trading, I have created a new channel called The Stoic Trader. I believe it will help many of you bridge these gaps. So if you think this kind of content would be useful to you, go ahead and check it out. The link is, as always, in the description below.